Welcome, everybody. It's great to be here. I came up from LA, and it's a good time to sort of take a departure from election news, which is blanketing all the media. So I don't even know what the stock market's doing today. I guess everybody's kind of just waiting to find out what happens with the votes tonight to a certain extent, and we'll touch on that a little bit later. But first, we have our distinguished panel here, and we're going to talk about growth versus value. Where are we in the cycle? What's your view on how best to take advantage of where we are? So on the far left there, I'll start with you, Omar Aguilar. Omar is the Chief Investment Officer of Equities and Alternatives at Alternative Asset Strategies at Charles Schwab, based here in San Francisco. Schwab total has about $3.6 trillion in assets under management, advisement, various strategies, including about $360 billion in their money market, ETF, proprietary mutual funds. And Omar, in October, your firm came out with a report that basically said, we're sort of nearing the end of the cycle. And so, as a general advice to people in this audience now, given where we are in the cycle, what should you do in your growth versus value balancing act?
Well, thank you. Thank you for having. Good morning, everyone. Hopefully everybody's enjoying the breakfast. Nothing better than a good breakfast in San Francisco, especially when it's free. But I actually will start with that. So free is gone. The days of free money in the market are pretty much behind us. And I think that's what you should enjoy from the breakfast today, because they may not be easier going forward. I think a big chunk of this includes the fact that we are indeed at the end part of the cycle. I would not necessarily say that we are at the point where we're turning, but all indications that we are at the end of the business cycle are clear with us. So first of all, liquidity is starting to be drawn out. You will actually see central banks, Fed being number one, continues to do $30 billion of, unwinding of their balance sheets, tightened interest rates, liquidity is starting to get out of the market. The ECB, the Bank of Japan will follow through. So all of a sudden, all the liquidity that we have had for the last 9 years, now is going to actually go the other way. What does that do? The risk premiums basically go up. Risk premiums are going to go up, interest rates go higher. What does that mean? Volatility is going to get higher. So we have higher volatility, we're going to have less liquidity. Deceleration of growth is probably the key word, and I just emphasize that as being the key metric for knowing where we are in the cycle. Deceleration of earnings, we already heard it. We have at the top of the profit margin cycle. That's clearly where we are. Deceleration of GDP growth. We have heard from China. We have heard from the other different countries on how difficult it is to continue to generate the level of growth that we have seen for the last 9 years. Now, 4% US GDP, yes, that was a good number, but it's going to be hard to repeat. Most likely, the fourth quarter GDP numbers will come at the 3% level, which is still pretty good for us, very good for us. But the 4% number is something that I think was probably unique to just the previous cycle reporting. So when you think about deceleration of growth, deceleration of earnings, lower liquidity, higher volatility, that to me smells just like the end of the cycle. Now, the only thing that hasn't changed is the credit market. The credit market is still behind, and those spreads are still very tight. Now, again, that's another sign where we see those spreads starting to widen, which I would expect will happen given that interest rates are higher, so defaults will have to come. It will be another sign that we're towards the end of that cycle. So, if anything, goes back to the books, this basically shows that every single metric, with the exception of the credit market, points that we are towards that end of the cycle.
And you guys came out with a paper that said basically get more defensive right now. And for stocks, that you said okay, healthcare, utilities, consumer staples, are those the areas that you think people should put their stocks in? And what should you sell if you're overweighting those?
So the normal cycle when you go from the growth towards turning usually means you have to go to quality. You don't go to value right away. Usually you go defensive first and then you go to quality. In most of the business cycles that we have seen in the past, we have seen that turn going to more, going from growth at any price, which is what we have been going for the last 3 years, to basically growth with quality. In other words, continue to be growing, and we not necessarily think that we're out of the growth cycle, but it starts to looking for earnings quality, start to look for sustainability of earnings. It's not necessarily pure defensive. Diversification provides you, defensive components, but the cycle towards what is traditional value is not quite at the point where we actually think that we're ready to move into that piece. Yes, if you look at what it looks cheap, and whether or not the last 2 weeks represent anything, yes, there's a lot of bargain hunting, but to the traditional measures of relative value, or even just the measures of PEs or price to books, they're still underperforming. So that component of shifting over to value completely is not there, where we think is the part. Now, that being said, given that I said we are at the end of the bull market cycle, it is wise to start thinking about quality, and it still is wise to start looking at areas where you can have more higher sustainable earnings growth more than just whatever can grow.
Great. Mark. Mark Lehmann is president of JMP Securities. This is the investment banking arm of the JMP group that's also based here in San Francisco. And just philosophically, you're much more of a growth guy.
I am.
A sort of perma-bull guy, you might say, or something like that. Anyway, let's hear the opposite case anyway.
Well, perma-bull is impossible.
Okay.
But I think growth over time is where you want to invest. And I think I agree with several of those points. But I think over time, you have to decide as an investor if you believe growth and the pace of innovation is accelerating. And I'll use my mother as an example, who 11 years ago, my father passed away suddenly, and she said, we got to go into bonds. My God, the market's going to be terrible, and what are we going to do? I got to put all my money in bonds and in money market funds. I said, well, you're 70.
This was 2007?
This is 2007.
Uh-huh.
And she said, this is late 07, and we got around to it in 08. And I said, let's see, you're 70, your mom lived to be 95, and your dad had emphysema and lived to be 93. So my guess is you're probably going to live between 20 and 30 years more. Probably not a great idea to be in bonds and cash. And it was a little bit of a dramatic example, but my point being, that was an easy decision to make back then, and I'm not saying it's an easy decision now. But I believe that the pace of innovation in this country and globally is still accelerating. And I believe that the access to capital markets is still genuine for a lot of companies, and we'll talk maybe later about which companies decide to go public and how late in their cycle versus when I started 25 years ago, which is very upsetting as a banker. But I see the innovation in technology, and I see the innovation in healthcare and biotechnology and things that are really changing our society for the better. And they are changing, irrespective of what Washington says. This country is going to get greener, and it's going to get more AI, and it's going to get more driverless, and it's going to get less coal, and we're going to cure more cancers, and we're going to do all these things that we're talking about over the next 10 to 20 years. And the investors that I talk to, the real seasoned people, talk about that pace of innovation accelerating. And I'll give one small example. One of the institutional managers who he talks to does a biannual technology trip out to San Francisco. Their trip was last week, in the middle of the tech wreck, where we saw Apple miss earnings and Amazon miss top line, and Facebook talk about investing for the next 2 or 3 years, et cetera, et cetera. And I talked to him this morning, and I said, how was the trip? He said, it was great. We were really interesting, and I'm a little worried here and a little worried there. He said, boy, but when I walked out of Tesla, man, do they have something. Boy, are they grabbing share. And yeah, Apple's investing for the near term, but watching that more from a product company into a services company, wow, that is really all these things that we're talking about are genuine and real. And yes, I agree we are near the end of the cycle, and rates are where they are, and we have concerns about China, and we have concerns about deficits. That is all true. But I believe growth is where you want to be, because that's where the innovation is.
So FANGs, stick with them?
Well, I think one of your comments at the beginning was that FANGs aren't all tech, and they're not all one pony. I think there's a very, very diverse when you buy those companies. They got very expensive. I mean, they were priced to perfection, and perfection's an impossible standard. If you believe that Apple is going to be really a services company, and they're going to really change the world as it relates to healthcare and autonomous and all these other things, it's not that expensive a stop. Facebook for a year is going to spend a lot of money below the line to make sure they don't replicate what happened in 2014, and I think they are still the growth engine. Cloud-based computing, which is in its is a huge market. Obviously, I still think this is in infancy, and you're going to still see that. So I think, yes, you have to have exposure. Internet economics leads towards monopolies. It's just a fact. I mean, we're looking at some private companies that should go public in 19 that are growing 60%, and they're already doing $300 or $400 million of revenue. You have to attach yourself to these companies sooner as best you can, because you will miss them. And I think, I still think the innovation in the tech side is there.
Mm-hmm. Carol Schleif. Now you get to be the deciding vote. Anyway, Carol is Deputy CIO of Asset Management at Abbot Downing in Minneapolis, which is a sort of family office, ultra high net worth money manager, part of Wells Fargo Bank. And so you basically are in the asset allocation business. Is that sort of a way of describing what you provide for your clients, or how?
Asset allocation is part of it, but also we help clients craft and deliver multi-generational solutions for their wealth in terms of, so we're managing institutionally sized portfolios, but we're doing it in an after-tax, real-world environment for individual clients. So there's a lot of extra things that factor into the way we think. And as far as voting on growth versus value, I will come up with the proverbial, it depends. And it really depends a piece on, we do believe we're later in the cycle, and it's very necessary to be quality conscious in what you're doing, but you can find growth in all kinds of industries, and it doesn't have to be the arbitrary growth versus value denominator. 35 years ago, when I started in this business, very first week on the job, my first boss said to me, if you're not a long-term optimist, this is the wrong business for you. And I've hearkened to that all along, because the Dow had just crossed 1,000, and we're at 25,000 now, and there's been a lot of intermediate and longer-term growth. And it's hard because, as we were talking about over breakfast, we're all anchored to this 10 years of up markets and low interest rates, and there's a whole generation of investors that don't know what volatility is like. And so you have to look at some of those factors too, but you can find growth in the most traditional old line value-oriented kinds of companies. And you can find traditional growth companies that have taken their eye off the ball and aren't growth companies anymore, and someone else is innovating around them. So what it really means is, at this point in the cycle, there's great quality investments to be had in a variety of asset classes, but you have to do your due diligence, you have to understand the balance sheet, you have to understand the market and where they're going, and it just takes a lot more effort as an individual if you're going to be an active manager in this kind of market.
What Mark was talking about, these essentially companies staying private longer, how do you get your clients exposure to those? Because I would think they're large enough investors that they could have the kind of exposure that maybe people who are sticking to stocks.
Right. We run 4 asset class portfolios. We have a very active due diligence effort in private capital, in single strategy hedge funds, and hedge funds in general. And we do have a lot of efforts that way, everything from early stage seed to later stage fund of funds and secondary funds. And so there's a really active piece there, and more of our allocation is going there, because it's hard in the public markets. It is hard to get an edge with all the algorithmic trading that's going on and all of the big investors. All you have to do is look at some of the reports out there about the underperformance of active managers over the long pull. Although we all think that we can be in that 10 or 15% that consistently outperform the rest and do it actively all along. But yes, we spend an awful lot of time in due diligence, but it takes an awful lot of time in due diligence and specialized teams to be able to go after those markets.
You had a report out this month called, the title of it was Divergences. And so your firm gave the best recommendation for an asset class was mixed positive, and that went to U.S. large cap equities, developed market equities, and MLPs. And the negative was to international fixed income. So what's so bad about international fixed income?
A piece of it has to do with the way the capital is flowing, and for our investors who tend to be taxable investors, a lot of the globe has been at low to negative yields, substantially below what U.S. yields have been. So it's tough, and you've got currency in there, and you've got all kinds of other special factors that weigh in on that. We think over the intermediate and even especially the longer term, though, when you look at demographics of non-U.S. countries, you look at GDP growth rates of non-US companies. You want to be a global investor, but it's tough to fight the capital flows right now, which are being attracted to a US, which had the extra boost of tax reduction. We've had the extra boost of reasonable rates, as even currency adjusted for foreign investors to want to put money here. And there's just been a lot of attractive things going on in the US market near term that has brought capital here and pulled it out of foreign markets.
Are you changing, any of you, sort of your advice to clients about how much to put into cash or money markets or fixed income versus equities?
I would say at our shop, we don't tend to think you have to pull it out of one and put it into another one right away. You can make some asymmetric moves where when markets are really strong like they were at the first part of this year, you can pull some off, and now that cash is yielding a little more, you can sit on 1% or 2% more before you go into the next. But we tend to remain pretty fully invested and not sit on cash as an unproductive asset class unless we get an inverted yield curve and it goes back to 5 or 6 or 7%.
Any odds on that happening soon?
We don't think you'll see the curve invert.
Uh-huh.
We think you've got enough inflation moving its way through the system. The market just hasn't realized it yet, and we all as investors and prognosticators tend to anchor to what we've just had. So that's why you haven't seen the long end move much. But the US government, the Treasury, is going to have to start considering refinancing all the way along the curve to meet the deficit goals that we have. And if they push it further out, we won't invert the yield curve.
Omar, one question. One thing that Schwab has that's like, there's a lot of Robo Advisor companies here in San Francisco, and Schwab has a big service in that area. How does that kind of work when there's a shift in your market view and you're saying, grow defensive or grow more value as opposed to growth? Does that Robo Advisor take that into account and, make any response on behalf of its account holders?
Well, a few things. Robo Advisors tend to be long-term focused. In other words, they don't necessarily do tactical shifts. And in a big part of the challenges of active management over years, and this is not just this cycle, but in general, is that investors, portfolio managers, analysts, anybody, they're humans. And because of that, they get emotional, and they basically make typical behavioral issues that we are well known and documented. So the overreaction, underreaction to news, they're trying to be tactical when they can't. It is clearly something that you try to mitigate by creating a robo technique that allows you to rebalance and try to do all those things in a more disciplined and rigorous way. So the robo advisors that we have don't necessarily do tactical moves. They are designed for the long run. They have long horizons as part of that, which means they will have a balanced mix between all the different asset classes and will try to rebalance. Now, what they do is in months like October, they will actually use that opportunity to try to harvest as much losses as they can to basically maintain the tax efficiency of the strategy, which is obviously the key part of what we do at Schwab. So if you think about what robo-advisors and what Schwab has as a philosophy, lower cost, that's a big piece for us, tax efficiency, and low tracking error or low risk overall. So if you combine those three things, they work in bull markets, in bear markets, and in the long run. So if you focus on what you can control, which again is taxes, sort of, low cost, and tracking error, in the long run, that will benefit your shareholders. Trying to time the market, it is very difficult. It's something that is not part of our philosophy. In fact, we basically have the clear solution or clear philosophical statement that said it is better to stay in the market than trying to time the market. So staying invested, going back to your earlier question about cash, it is more important than trying to see if you can take the money out of risky assets and then hold it and then figure out what is the right time to go back in. Because I can tell you, most professional investors will not get it right. We will not even try to get it right. And again, a big part of our philosophical view at Schwab is, the behavioral biases that we all have is a big part that usually work against us. And if we can actually help shareholders by mitigating those biases, it will be through the Robo Advisors, it will be through understanding what their needs are, but at the same time, to try to get a process that allows you to focus on the things that we can control. Now, the big component of what I think it is as we shift to the cycle is the fact that the US economy is actually in pretty good shape. We are in very, very good shape. And I would actually echo what you said in terms of looking at the US relative to the rest of the world. You know, I hate to say it this way, but the US economy is the cleanest dirty shirt. Basically, it is the best you can get out there. It's not growing at a very fast pace, but it clearly looks much better than anything you can see in the rest of the world. And for that, we obviously have, the 10-year yield that is the most attractive of grown, pretty much any of the G10 countries. And therefore, the demand for our bonds will continue to be high unless, there's a big change in their economic prospects.
Mark, you were saying before you were going to name some names of some stocks that you think, are good bets. And also, if there's anything that you'd like, I wouldn't put my money in that.
Yeah, listen, some of the companies I'm going to mention are the highest growth companies and the ones that are expensive, but I think they are the best companies. There's a company called Okta based here in San Francisco. There's a cloud-based computing SaaS company that is really the pick of the litter. It is trading at a ridiculously high multiple even after the correction of October, but it's a company, if you have a chance and you see a day when the market is like it was afflicted pretty difficult, the VIX spikes where it had 30, et cetera. I mean, it's a great company. There's a mid-cap home builder that we've helped take public almost 10 years ago called LGI Homes. It plays well into the demographics of this country, which is people are getting, would rather buy than rent. They build homes that are as attractive to buy as it is to rent, similar price. They offer you kind of that one model. They don't say you don't like that coriander, pick this one. It's basically one product, but it's in...
No granite countertops.
No, well, and if there are, there's one kind. That's all you get. They're not changing the fixtures. So my wife would not like that as an option, but it's an amazing company. It's based in the South. They're expanding to Colorado and some other places. It's a terrific place, market that they want to serve, the kind of move up market from rental. And I think you got to look at biotechnology. I think you got to look, and it's very tough to take single stock risks with biotechnology, but you see the kind of innovation and you see the kind of premiums that big pharma would rather pay $10 billion for a drug than $1 billion before it takes off. That's just the way they think, and the pipeline for them is so muted that they're buying more and more of those companies. So I think you have to have some sort of a basket of life sciences companies, because that pace of innovation and that ability to cure diseases that we thought were incurable is just real. There's one based in Germany called Morphosis. This ticker's MOR. It's up a lot today, but it's not up a lot on the year, and it's just an incredible oncology-focused company that you want to pay attention to. But again, it's very hard to pick single stocks in a room, but those are three of the highest growth companies and some companies that we really respect there and like a lot.
And Carol, as we're getting towards the end of the year, you guys have strategy advice to your investors. What are some of the key takeaways, especially for people in a state like California that's a high tax state that is getting hit by the SALT deduction limits?
Big pieces of the tax planning are to make sure we have those planning meetings with planners and your accountants and your lawyers and everybody else, because there's a lot of changes in the tax law, both positive and negative, for everybody. Minnesota's a high SALT state too, which often goes unrecognized, but a lot of states are, and it's one of the reasons why in the passive exposure we're very attuned to being tax efficient with that. And other advice that we do behind the scenes that we don't necessarily bring our clients into is look even at our active managers, get a pre-read on what sorts of gains they're going to pay out, and decide if we want to sit with them through those gains distributions or if we want to rearrange portfolios. So there's a lot of different levels, a lot of planning that's going on with clients right now, especially they're watching the midterms, trying to figure out, do all of the components of the current tax law stay after, effective tomorrow? Will they likely stay? So there's an awful lot of, there's a whole variety of things that we're working with clients on.
You brought up a good thing that I want to as we're getting near the end here, the election. So there's, the base case is that the Dems take the House and the GOP holds the Senate. There's the case that, the GOP, big surprise, they, hold on to both. And then the flip case is the giant blue wave that the Dems, somehow managed to get control of both houses. I'm wondering, for investors, what can you do with, base case, blue case, or red case?
Well, I think you have to be careful saying base case or blue case because it depends on where you come from. If you come from the Midwest, you think it's more of a toss-up, like we did 2 years ago. And the interesting thing is, too, is when you look at the elections, none of us had it right 2 years ago either, because people thought the case that came through would trash the markets early on, and it did the exact opposite. So there's that piece of it. But I think people will look really carefully at the verbiage, and it might take a few days to sort of sort through what comes through on all of this. But I think no matter what comes out, people want our legislators to go and legislate, and they want them to work together. And this common misperception, if you will, that markets like gridlock, markets have gotten pretty frustrated with gridlock, I think, in the last few years. So everybody's looking for people to go to Washington and go to their state houses and go to their local municipalities and do what we're electing them to do.
And Omar, what's your take advice on the election?
Well, our advice is very simple. Market doesn't like uncertainty. The general, after tomorrow, we're probably going to see a little bit of a relief one way or another, and there's going to be changes. Clearly, depending on the different scenarios, that affects different sectors. Obviously, in many cases, the one that is always at the top is healthcare. Healthcare is always an area that will be affected by whatever results of the elections are, mostly because of, both parties have very different take on how to work on healthcare. Regulation, and in terms of being more friendly towards the market, in terms of potentially another tax cut, potentially, more stimulus, that obviously, refers more of, what the market may be looking for. If there is more gridlock, that actually also helps certain other sectors that, prefer to have that less regulated market. So I would probably say that because it's still up in the air, the good thing is that tomorrow is going to be over, and I think the market is actually going to like that.
Then we get to start working on 2020 as of Thursday,
yeah,
right?
there will be a lot of extrapolation towards that. That's very true. That's
true, yeah. I mean, one thing, Mark, a lot of the internet stocks are potentially facing regulation. Is there any electoral outcome that might clarify or give direction on which way that's going to go?
Yeah, I doubt it. I think we've been hearing this specter of regulation for the last year or so. They've self-regulated to a large extent right now because Congress hasn't done a lot. If you remember the testimony of Zuckerberg, I think half of the senators didn't even know what the company did. So I'm not sure that's changed a lot. But they're stepping up their own policies because I think they fear something even worse than what we saw in 2016, the headline that they don't want to see again. So you're seeing that kind of cost below the line for a lot of these companies. I kind of I'm in between the results for tomorrow and what we'll see, and we may not see the final numbers till the end of the week, just the way people's ballots are counted, et cetera. But the market has been very tenuous for a month, and I think anything is better than not knowing. And I do think we'll most likely, just given the pundits, and I do agree that there's no huge wave. There usually is some sort of a wave for the other party. Surprisingly, given how much rhetoric there is about a wave, there always is a midterm loss by the incumbent party. That just always happens. And in certain years, it's been 80 seats, and that's not going to happen this time. But I think what you will see, if anything, is the ability, if we do have a divided House and Senate, for people to try to find things to get done. Because, like you said, we're not too far from 2020. I mean, people are going to start hanging out in Iowa very, very soon. Your neighbor, and people are going to start talking about that and what the referendum was on today's election. And I think overall, more self-regulation and more looking yourself critically is probably good for these internet stocks.
Mm-hmm. And we're getting toward the end. We got about 3 more minutes. So each of you, sort of 1 minute, what would be your best recommendation for investors, starting with Omar, in 2019?
Yes, so prepare for more volatility. That's definitely the case. We always tell our investors we're back to normal. I think people may not recognize that the last 9 years have not been normal. We're going back to the levels of volatility that we should have in the market. And therefore, be careful with momentum. I think we didn't get a chance to talk about that. But, this year, more than growth has been a momentum story. I think the growth story is actually a positive one. But the momentum story, which affected the FANGs, is something that I think we continue to tell investors to be wary about. A way to mitigate that is to actually go to smart beta. Anything that is away from cap weighted, anything that takes away from just getting more into the bigger names will actually benefit diversification without necessarily taking out yourself from the market. We're not in the point of staying out of risky assets. So if you want to stay in the market, smart beta is a way for mitigate a lot of the momentum strategies that are built into this. And again, the growth benchmark's a typical one. It's heavily concentrated in 9 names. You want to be careful with those. You want to diversify by having some access to smart beta. Something that is non-cap weighted is usually a way for mitigate what may be beneficial in 2019.
So what's a smart beta fund that has the momentum factor that you could avoid?
Well, I actually want to stay away from momentum. I want people not to buy momentum. They already have momentum in their market.
Right.
You're a beta manager, you already have momentum there. So that's typical. The cap-weighted indices, they have momentum embedded into their methodology.
Right, but what's one that avoids the momentum?
We have a set, if you want to come to Schwab, a set of fundamental index strategies that use value signals to basically weight based on the economic value of the companies as opposed to the market cap. So that's a way for them to invest directly. Our Robo Advisors combine cap-weighted with fundamental as a way to reduce volatility and mitigate the effects of momentum.
Mm-hmm. So Carol, what's your advice for the coming year?
Stay invested, stay diversified, up the quality spectrum, stay global, and control what you can control, the costs, the taxes, so stay attentive and do your due diligence.
And Mark, what's your...
I think it's consistent with watch the volatility in the markets. This is our third 10% correction we've had this year, so you've had plenty of chance for volatility. I think volatility will reign supreme going forward. I think you're going to get opportunities to buy the best companies at discounts over time and watch those. And when the market gets stretched, use those as opportunities to balance yourself. But I think over time, you want to be in the highest growth sectors because the market is dynamic, the economy is growing, innovation is accelerating, and you have to be exposed to those for the long term.
So buy the dips.
Buy the dips carefully, but yes, those are opportunities because we have way more volatility, and volatility will provide you opportunities to get into prices that you wouldn't have seen before.
Mm-hmm. Great. Well, thank you very much. We're right down perfect timing now, and so a pleasure being here, and hope you guys got something out of it.
Thank you.